So happy Friday, everyone. Here in our broadcast, we've got Paul Levine, Fred Sams, Betty Withrow, and we sort of just have her fun nick naming this the Frick Frack and Friends show, and Paul's going to explain what that is. But our topic today is about real estate investing. Oh, we lost Paul. Okay, real estate investing and taxes, and uh, maybe maybe Fred, until Paul shows up again, do you want to explain what you guys had in mind with the frickin' frack show?
Well, I think one of the things that we wanted to speak to was just really the lack of awareness of what tax strategy can provide for commercial real estate investors, and as well as for commercial business owners as a broad brush. Um, we're involved with helping our clients in tax advisory save tens and in some cases thousands, hundreds of thousands of dollars, depending on what their asset is and its value, and consequent tax consequences. And so I think one of the things we're going to touch on, we're a group. I'm a licensed commercial broker, and Paul is a real estate agent, and that's a group that can both provide a lot of value to their clients, as well as recognize a significant opportunity for themselves in terms of being able to sell more property to investors and commercial property owners in terms of transactions. And a practicing CPA for over 50 years, and just kind of talk about the lack of awareness, even at some of the tax professional levels, how having not utilized cost segregation or research and development credits or 179D deductions, all of which are things that we will begin to expand and expound on a bit more as we move along. But just that lack of awareness that they exist and just how valuable they can be was sort of the where we were going to take and run with our conversation today. So
Yeah,
did
I
that
think
character disappear? Did he?
well, yeah, they were working on a television in the next room, so I think maybe they unplugged his internet. So Michael is here. I don't know if Michael's available. We can bring him on screen
Oh,
and you can.
Paul is calling me right now, so we'll find out. Hi. You got closed out. Well, we've been trying to figure out what happened. That maybe you got your internet unplugged when they were working on that TV in the next room.
Welcome to live television, everyone.
Yeah, it's live television at its best. So if you can get back, that would be great. Michael just came on, so I'm going to hang up and let me come on back, Paul. We miss you.
So Michael may also be in the washroom too, but Fred, maybe you can introduce Michael here, and because he's a new member of your team, right?
Absolutely. Michael has, we've worked together with Michael as a client. He is an active investor in the single family space. He has several assets which provide which are long-term rentals. And, again, this was a situation and place and time where Paul and Michael have been, and I'll let Michael expand on that, but they've been friends and also a client for a while. I've recently met Michael over the last year or so, and he's an extremely talented marketing individual. He's got both a strong technical background as well as a visualization background. So it's really great as I start talking to him about some of the things that we're needing to offload. He can really understand what that need to systematize those systems are. And so Michael's a real welcome addition to our endeavor. Michael, you want to say something? Don't be bashful.
Good.
Hey, how's it going, guys?
Good.
Good.
Sorry, I was just finishing up the meeting, and so
No, that's okay. We lost Paul. I think he's got a technical issue at his end.
okay.
And yeah.
So my name is Michael, and I've known Paul for 10, 11 years, and I've gotten to know Fred, I don't know, since September, October of 2023, and so we've had some good conversations about property, and it just seemed, as we kept talking, more and more of different opportunities, cost segregation, wholesaling, other types of investments and products. We just kind of clicked, and I was like, hey, how can we put our skill sets together? And so that's kind of how we got to where we are right now, and collaborating and brainstorming how to work together. So yeah.
No, that's great. So Paul, before everybody else got here. Oh, here he comes. Okay, there's the timing's good then.
Good.
Okay.
That was annoying.
Yeah, that was annoying. Anyway, so I was just about to introduce your discussion topic, just in case you didn't come back. So you mentioned that you wanted to talk about renting out residences and the tax considerations for that.
Well, I want to just mention the fact that we are cost segregation specialists. Fred has been doing it for a very, very long time, and Fred and I got together somewhat over 2 years ago, and I learned it really fast. And cost segregation is something that defers income taxes, doesn't save you income taxes per se in the beginning, and it gives you some wonderful cash flow. And if you're talking about renting out a residence that has a market value or cost you, million, $2 million, $3 million, it's got a lot of good stuff in it. And that good stuff, the appliances, the countertops, the cabinets, in the kitchen and in the bathroom, and all over the house yields you a wonderful, and I mean a wonderful depreciation deduction that you can take a good part of in the first year that you put the asset in service. And it's a wonderful benefit if you know about it. And the problem is that the people who are dealing with it from the standpoint of the realty office is they do residential leasing and residential transactions, and they don't come close to the commercial deductions that you can have, like accelerated depreciation or bonus depreciation. And so what I did was I get emails every week about leasing different properties, different single family residences in different cities. And some of the rents are pretty high. And I've been calling the realtors in order to give them a clue about what cost segregation is. And they don't know it. But what's worse, they don't want to know it. They don't want to complicate their lives. They have a couple of very simple tax things that they have to remember. For example, if you own the house and you lived in it for over 2 out of 5 years, then both the husband and the wife, if you have a married couple, can deduct $250,000 from the capital gain. They can do it. They can both do it for an aggregate of $500,000. Excuse me. I don't get paid for this, but it's Coca-Cola. Anyway, so they don't want to learn. And I'm going to say something now that's probably going to get me a pie thrown in my face or an egg thrown at me, like I happen to be a big MASH fan, and one of the scenes that they promote is Radar with his bugle and somebody throwing an egg in his face. But the people who do residential leasing or residential transactions, both buys and sells, they're not technically knowledgeable. They don't want to be technically knowledgeable. They want to make their 2.5% commission or around that. And they want to go on to the next transaction. So they don't necessarily care that there is this wonderful deduction. And I am back writing my articles, maybe not every day and maybe not at 6 o'clock in the morning anymore. But I posted an article about the fact that the IRS basically gives you an interest-free loan. I'm going to say that again. The IRS gives you an interest-free loan when you do cost segregation and have a nice size, I was going to say huge, but a nice size deduction on your tax return against your other income. And I'm not going to go into the fact that you can or cannot be a real estate professional. That's a discussion in and of itself. But the point being that you get a tremendous tax deduction today, depending upon how large the property is, how much you paid for it, and a lot of other factors. But you got to at least look into it. So you
Very
get,
good.
excuse me?
No. I said very good.
So let me finish the thought. So I guess I was blacked out with it. Anyway, smile, Michael. The deduction, it can be huge, and you get the deduction today, and then down the road, 5, 7, or 15 years later, it catches up and you have to pay it back. But I'll tell you something. Number one, there's no interest. Number two, there is a way to change the income that you have from ordinary income, taxed as high as 37%, into capital gain income, taxed at 20%. I'll do that all day long and twice on Sunday. So, you got it. That's why you can't just go to somebody and say, buy this house for me. Or you can't go to somebody and say, I need to get a well-rounded real estate investment portfolio, and they don't know anything about cost segregation, and you're going to leave it on the table. Yes, sir.
Yeah, let's drill in there just a little bit. When we talk about that loan, a loan's like anything else, in the sense that when you see that acceleration, that accelerated depreciation, and that comes on the front end, realize the longer you hold on to the property, the less recapture you have to pay back.
Right.
So you, my friend, you seem to leave that little piece out. And we like to think that many times, let me finish, many times we have, you have clients that plan on holding on to that investment. They're not planning on selling it in 5 years or 10 years, where then there's a heavier calculation of recapture. And recapture comes in all forms, okay? But simply enough, let's be clear. If someone's going to take an asset, say it's an apartment, say it's a home, and they're going to keep it for the long term, then their payback keeps becoming reduced.
Right.
As each year
it
goes
goes
by.
back. What happens is that for the first 10 years, for the first year, I think it is, that you hold on to the property, and this I have to look up, because I haven't done it in a
Once you
long
start
time.
passing over 5 years, then that recapture starts to come down. And also look at what well, let's not beat that horse too much. But if you're taking what was normally a 27-year period of time that you were running those assets against, and you can bring them down into 15 and 5-year windows, then you're paying a percentage of that 15 and 5-year that you got to see in the first year in the case of bonus depreciation, or you got to see it in 5 as opposed to stretching it out to 27. So it's a little elastic. You have to kind of think in those terms, particularly if you're going to hold on to the investment. But I think not to kick and beat that horse too much. The point to be made, and my partner made it well, many real estate agents and those types of professionals could really do a service to their clients, particularly when they're investors, or especially when they're investors, to their clients, as well as to themselves as real estate agents, allowing themselves to have more opportunity to sell more real estate for other investors, because they're showing them how to create tax savings, which can be significant.
And also, the one other thing that we have to remember is I'm just plugging in on realtors right now, and it looks like I'm beating a dead horse. But CPAs don't want to hear it. Attorneys don't want to hear it. And it's the article I wrote and published said that now I got to remember the article. It said that I'll come back to that.
Well, you've written a whole handful of articles.
Oh, I remember now.
Yeah.
The point being that CPAs don't know it because it's brushed over in the best of continuing education classes that I've ever seen. And the last time I went, which was February of this year, the lady, who is very knowledgeable, said, "Oh, and then there's cost segregation, and it helps you with depreciation." And she was going on. And I put up my paw and I said, "You can't just say that." And then we got into it a little bit, and I appreciate the fact that they did talk about it. But CPAs aren't giving it, and they don't want to know about it. Realtors aren't giving it, and they don't want to know about it. And I can go on and on down the list.
It's a bit of a wonder that they don't want to know about it, because Fred, before you got on, was saying that the savings could be tens of thousands and sometimes hundreds of thousands of dollars. So why wouldn't they know about it for themselves and their clients? Really, what's going on there?
Yeah, again, I think what I've seen with CPAs, and one of I felt very fortunate when I finally partnered up with Paul. His jokes aren't as good, but he brings a bunch of other things to the table that I'm very fortunate for. One of which is just what we spoke to. There are those CPAs. You see here with cost segregation, the first thing that needs to be in my mind is a business decision. Does a tax savings, let's get away from the loan piece, but does a tax savings up in the front end of X number of dollars make sense to me?
You betcha.
Would keeping that much more of my money in my pocket make sense to me? That's a business decision. And too many times someone defers that to their tax professional. Well, I would say, in my mind, and the way that I approach that, well, first, that is a business decision. And I like my tax professional, in this case it's my partner, so I'm fortunate again, like me and Michael both are. But let's have that conversation. Help me understand why. And then if you can explain that to me, and that makes sense, then I understand why I should or should not do.
Right.
We have a frozen Fred.
Frozen Fred. Yeah. The frickin' frack and Frozen Friends show. But anyway,
Just so that the audience knows, there is a phrase, at least I think it may have been a New York phrase, that frickin' frack do certain things, and it's basically you and somebody who mirrors you in some way. And Fred and I both come from New York, And so when we talk about working together and doing presentations together, it's wonderful that he'll start a sentence and I'll finish it, or vice versa. So we call it the frickin' frack show. And today, Greg went even further and said it's frickin' frackin' friends, and I loved it.
I guess the short version would be the Frock and Friends show, but that could get us into trouble. But or the Frickin' Friends show. There we go. That's even more trouble. But
Stop, Greg. You're already.
You're on a slippery slope.
I'm going to go back to this thing about why CPAs, accounting professionals, wouldn't want to know about it. Is it because they're not, as you alluded to it earlier, that they're not even, it's just skipped over, right? Well, there's this
it's
cost
not
segregation, and that's and then they don't even know what they don't know, right?
Yeah, and it's not considered important. It probably has never been on the CPA exam.
Yeah.
And if it's not on the CPA exam, the people that teach you aren't going to consider that really important to teach you, whether it be in university or continuing education, which is a follow through of university.
Right.
So they just don't know it and don't want to know it. And then you go to the realtors, and the realtors don't want to do. Hold it, Fred is calling me. We got to find out what's happening.
Okay, I'm gonna just go to make a comment here. I think Fred alluded to another thing here,
Yes,
in
sir.
that it's actually a business planning issue, not necessarily a tax issue, or even a real estate issue. Business planning.
Okay, so cool it down. We'll be here for a while. I'm sorry, I didn't hear that. Fred has a problem that his system was overheating, so he'll be back in a little while.
Yeah, I made a joke about not having his parking brake on and then rolling down into the river or the ocean, but that was something else. But anyway, what I was saying is, what Fred was saying is, it became what I got out of that is, this is not necessarily a tax issue or a real estate issue, but it's a business planning issue that needs to be earlier on in the process. And maybe that's part of the reason why it's not really, tax accountants don't necessarily think of it, and realtors don't really think of it, because they're not taking a business planning perspective on it.
They should. And part of the reason that they should is, when you get that kind of a tax deduction, you're increasing your cash flow immensely. And when you go to buy a piece of industrial property or investment property, the bank only wants to know, how are you going to pay it back? It's the only thing they're concerned about.
Yeah.
And so if they look at the fact that you are doing cost segregation, and that it's generating thousands, tens of thousands of dollars of cash flow for you, that's how you're going to pay it back. Or, going back to what Fred said, as far as business planning, you can also end up having the money to fix up the property you just bought, and that helps in cost segregation. And then you can also end up purchasing property next door. Say you're doing self-storage, and you've got one row of units, and the lot next door is available. You can buy that and then later fill in those units as well. So it is, as Fred said, business decisions, and you got to keep it in mind. And so many people aren't. And we're taking all of this time because it really upsets me. And it's a profession that I really considered, one of the best. And I'm finding so many people don't care about this.
Yeah. So there's seems to be a gap in the education here, which you're filling right now with your articles, and we could fill as a group probably.
Well, but it depends on how many people we can reach.
Well, and
Mikey?
I think I'm not a tax professional and I'm not a cost segregation expert, but as a real estate investor myself, um, I think some of the disparity there is also when the cost segregation specialist and the tax professional, their clients are not educated. So I remember coming up to Paul and saying, "Hey, we have all this equity in our home. I feel like there's something that we could do there, but I don't really know what." And so from that led on, that was 5 years ago, and 5 years later, we have, a multifamily unit and a single family, and there's only goals to grow that. And I think there's when, as a client, and as a customer, from that aspect, I don't know all the options that are there. So if I'm educated and if my CPA can help me, if my accountant can help me, if the people that I know can educate me what's possible with my options, um, then that's going to help. Then I'm going to ask them questions. I'm going to say, "Hey, Paul, well, can you tell me about, is it going to be better for me right now? Or what are the benefits of a small term rental, a medium term rental, a long term rent?" I'm going to ask those questions because even in the circles where I'm discussing with other groups of people who are real estate investors, we're talking about all the questions and options and what can we get out of this? How can we have tax savings, or how is this going to benefit us? How can we leverage what we have to expand? And it is a lack of education, but it's not just the professionals, it's also the clients. And it's like a full trifecta of so much education needing to get out there.
Well, what people like you and your associates who invest in real estate together should do is, if you do a Zoom meeting, you should have me part of it. And when you get into the business planning aspect of it, you got to touch on all bases, because if you don't consider everything, you're making a mistake. And one of the big areas that, number one, everybody hates, and number two is the biggest reality in the world, is income taxes. And how is it going to affect us? Because that affects the rate of return, the internal rate of return, and everything else.
So I just posted in the chat who would be interested in learning about cost segregation. And I know from you don't know this, Michael, but Paul's often a guest on, we do a broadcast on Saturdays with a number of real estate investment note investors. And they're often, even in our discussions, they're asking Paul about cost segregation. And I think you've had meetings with people afterwards. So I think there's a huge need for people to learn more about this. So my proposal is that we actually provide some training material along these lines, because I think a lot of people need to know it. And you're right, Michael, it's not just, it's the tax professionals, it's the realtors, it's the real estate investors. It's a lot of people. They can make better choices if they knew more about this.
Absolutely.
Yeah, and investing in real estate, the only other word is educate yourself.
Yeah.
Because if you're not educating yourself, you're not asking the questions, and to use a word over and over again, you're not making an educated decision, an informed decision. And I won't tell you what to do. It's not my job. It's not my money when we're buying a property for you. I will suggest and tell you what your options are, but you're going to make the decision, and therefore you have to be educated in order to make an informed decision.
Yeah, I think, and many people won't even know what the process is, like how, and that's where they need to start a conversation with you.
Very true. Yeah. Very true.
So please, for those of you who invest in real estate, for those of you who want to invest in real estate, for those of you who want to possibly reduce your income tax, and don't go to the guy that says, I'll set it up that you won't pay any tax. I happen to have a way to do that. But I will go through step by step how that works. And these other people are going to say, oh, we have to set up this kind of a trust, that kind of a trust. And basically the IRS is sitting there going, oh, I can't wait to write this one off. And then the IRS comes in about a month before the statute of limitation comes up and sends you a bill for tens of thousands of dollars. And you haven't got time to fight it, so you have to sign an extension to the statute of limitations, meaning that they have all the time in the world to go through you with a roto-rooter. So don't be stupid. Don't think that there is that answer out there unless somebody explains it to you and goes step by step, and then you can look it up on Google or on whatever, DuckDuck, whatever that one is, the competitor for Google. But do research. Don't just take people at their word. And if you do research, if you look it up, you're going to remember it. And that will give you the ammunition to ask people like me great questions and questions that matter.
So if you don't want a close encounter with a roto-rooter, call
I didn't
Paul.
see where they would put the roto-rooter.
Yeah. Well, we don't want to go there either. We are already going to be banned, but there we go. So, yeah. So, and I guess we should mention that very soon, maybe as early as Monday, the Bible of Real Estate will be launched and published.
Yes.
Yeah.
It's coming right along. All we need to do is get it through review, and there it'll be ready for you.
Yeah.
And I appreciate everything you guys have done. And I never even considered the fact that I would ever be an author. But I started with the articles and I like doing it. And fortunately, they are received very well.
Yeah. Okay. So any last comments other than to contact Michael and Fred and Paul?
Well, number one, watch these things if you can.
Yeah.
Number two, listen to what we say, and then after we do something like this on a topic like cost segregation, go to your computer, Google the hell out of it, learn, because the best thing in the world you can do is ask good questions. And you can't ask good questions if you don't know what you're talking about.
True. Yeah.
All right. So you've got the contact information on the bottom. There's Paul's phone number, and you ask for people to phone after 10, I think it is.
Yes, after 10 a.m. Pacific.
Yeah. And your email address and the website. And then we have the Bible of Real Estate.info where you can take a look at. You can actually get a preview copy of the digital version of the book there. And Dynamite. We've had a few people take that up. So anyway, happy Friday, everyone, and we're gonna continue this conversation next week. And come on back.
Yeah.
You betcha. Thank you, guys. I really appreciate it.